Hello, welcome back. Mike from Canavan Wealth. Want to talk about 529s. We had two blog articles go up on the website right here about 529s. They're a little bit different. I want to jump into this one here. 529 is something I talk a lot about. A lot of my clients are kind of past this age, or they're working on 529s for grandkids. But a lot of the people I hang out with and kind of talk to on a more kind of casual basis are looking at 529 plans. 529 plan, if you don't know what it is really just an education savings plan for college for the most part. Something called a Coverdell that's a little bit more open in terms of what you can use it for, but most people end up in the 529 world. They're typically state run plans. The plans themselves, specifically ones run by the state, are usually pretty good. The one here in Idaho is called ID Saves or Ideal. I think it's run by Vanguard, is ultimately the company behind it. I've never had any real problems with it. Investments are pretty good. Fees are usually pretty darn low. Um, so let's quickly run through kind of what a 529 plan, kind of how it works, and then I'll talk about my thoughts, because the simple truth is I'm not really a fan of them. Not because I think they're a bad investment or anything along the lines. It's really just because of the reduced flexibility for young parents. So the income tax of them is that the growth is not taxed from a federal standpoint, which is, I'm going to get to when I go into the example, is different than what most people think is happening. Similarly, state income tax is not withdrawn, and you actually get this part deducted. You actually, if you use your state's plan, you will often, you have to check with your individual state, get some type of a deduction on your state income taxes, right? Which is typically substantially less than any type of federal tax you would pay. If you do take money out of the plan for things and use it for non-educational purposes, then there is a 10% penalty, but only on the growth. Again, usually not as bad as people make it out to be. And there's a lot of interesting tax things that you really need to work with a CPA or really understand well when you start dealing with 529s in terms of what is and what is not taxable. The one thing I will talk about that is that they are surprisingly flexible in terms of getting the money out and paying for it. It is typically not something where you have to take the money out and have it paid, like the check is made out to the school or anything. You just pay the expenses. Those show up on your taxes as qualified educational expenses, and then you just have to have as much or more than that of what you withdrew from your 529, and a CPA can help you out with all that kind of stuff. I am not a tax professional, so all this stuff about taxes, understand, I'm not a CPA. All right, I want to jump to my little slide here about why I don't think 529s are the first place to turn to young couples who want to save for their children's future. It's not because there isn't a tax benefit or the investments are bad or the fees are too high or anything of that. It's because it removes all flexibility from your financial situation. And I don't think the economic benefit of it is good enough in order to take that reduction. I do think they work for one group, which will come up here. It's down at the bottom. But so let's say you invested $5,000 a year for 10 years, which is quite a bit to put into a 529 plan, especially for young couples these days who, it's tough when you're raising kids and putting them through school, starting to make your way through that kind of the professional world to hit this kind of target. But let's say that's what was happened. So we got $50,000 invested in the 529 plan. Remember, that's all post-tax money. The most common misconception I see about the taxation of this and the benefits of 529 plans is that most people in this age group, they're familiar with 401ks and IRAs and how those work. They're not familiar with non-qualified investments, as we call them, or single name or joint accounts, and the way they're taxed, right? You will, the first thing to understand is that 50,000 invested is post-tax. You do not get a federal tax deduction for putting it in, and it will not be taxed when you take it out. Unlike taking money out of a 401k or an IRA where you pay income tax on what you contributed as well as the growth, in a 529 plan or like a joint account, you don't pay tax on your principal or your cost basis, right? So let's say the account grows $20,000 over that 10 years before you're going to start spending it on your child. If you were to pay taxes on that, it's going to be interest, dividends, or capital gains. which is going to be around 15%. Just trust me on that. So you're going to end up not paying about $3,000 in interest, dividends, capital gains over that time if you have it in a 529. Similarly, if you're using your own state program, which I would recommend you do as a general rule, I can't speak to all 50 states, but the one here in Idaho is pretty good. The state tax deduction, here in Idaho, maybe your state tax is around 5%. Again, you're going to get the deduction based on the contributions, but it's not a federal deduction. So you're going to get about $2,500 in tax savings on your state taxes. You add that all up, you save about $5,500 over 10 years, or about $500 a year. Now, there are not many people in the world where $500 is not a meaningful amount of money, and I'm not trying to tell you that $500 a year is not an important amount of money. I just don't think it's worth tying up $70,000 that can only be used 10 years from now at school for a lot of young couples. It's not the first place I would start saving. If you already have your little kind of emergency savings, where typically not in some type of investment, but in a bank where something goes wrong, you don't have to go on credit cards. And then you're making substantial contributions to your retirement savings. Then after that, I wouldn't go to a 529 plan. I'd just go to a standard joint account. If you just put this into a joint account or a brokerage account, sometimes called, you're going to end up paying these taxes. The important thing to understand is you pay those taxes year to year as you go. I think a lot of people think that the 529 plan is in some way going to be larger than if it had just been in a joint account. That's not the case. You get tax statements throughout the year, and you end up paying this about $500 a year more each year on your taxes. The account itself, if the investments were the same, is largely going to be about the same amount of value. It's not that you're going to have $5,000 less in the investment account when your kid goes off to school. Now, you might owe some taxes then based on capital gains, but that's getting down into the weeds. I don't think it's worth it. Specifically, if your child does not go on a standard educational pathway, if through college they want to start a business or some type of illness in the family. Now, there are some like hardship things in a lot of these, but I wouldn't rely on those. There's lots of other things that can come up, or you yourselves just go through a period of unemployment or anything like that. If in any way through this time period you have to start going on credit cards or taking on debt that is not smart, because a lot of your assets are locked up in 529 plans, I just don't think it's smart. Now, the counter argument to this is about the penalty, right? Because if you end up using this money for non-educational purposes, it's a 10% penalty, but only on the earnings, which is what most people don't understand. So the 10% penalty on the $20,000 of earnings that the account made is only $2,000. And then you're also going to be taxed on the 20,000 on the growth. It's going to get taxed. And that's going to largely kind of come out to the same amount as about the 5,000 that you saved putting into it, right? So it's not that if you do have to use it for something other than education, it's this huge problem. However, I still just don't like the flexibility. Now, for grandparents, I think it's a great option, right? Or for people who have already met those first three wickets, the emergency savings, they're saving in their retirement plan, and they have some type of non-taxable investment started. If you're doing really well financially, then 529s can make a lot of sense. For grandparents who want to know that this money is largely going to get used for something in the child's future and isn't going to go to a summer cruise or something like that, 529 plans can make a lot of sense for them. Unfortunately, they often, because they may not be in that state, don't get the state tax deduction. You can get around that with some smart gifting and things like that. We can talk about that another time. But so grandparents, I do think it is a strong way to go and can be, very meaningful. One last thing, just, kind of a last tip on 529s. Many states do not have a holding period in terms of how long you have to have the investments in the account. So a lot of people will just, in the year that they are going to use money for college, they will do the max level contribution and then almost immediately take it out to pay for college, right? So I think in Idaho, at some point it was $6,000. I don't know if it still is. You contribute $6,000 January 1st, take it out a couple of weeks later and pay your college bill in February or March, and you still get that state tax deduction. money actually isn't in the account for very long, but it counts throughout all the system. The whole tax for growth and stuff really doesn't matter, but you do get that little state tax deduction. A lot of people, it's more hassle than it's worth. It's a lot of paperwork. You have to typically have a whole nother account kind of separate from your investments. And I see a lot of clients are just like, I just don't want to deal with it. Another login, another, kind of image of themselves out there that can be identity stolen or things along those lines. Okay, webinar tomorrow, actually, Social Security, May 19th at 10. You can sign up for that still on the website. If you like the video, please like it and subscribe to the channel if you want to see more content. Otherwise, I will talk to you soon. Thank you.